Welcome back to the deep dive. We're diving into financial crises this time.
Oh, yeah.
A world that's both fascinating
Absolutely.
and, let's be honest,
Yeah,
a little scary.
for sure.
We're using Charles Kindleberger's Manias, Panics, and Crashes, a history of financial crises,
A classic.
to unpack historical bubbles and crashes and the forces that drive them.
You know, it's remarkable how history seems to rhyme, especially when it comes to finance.
Right.
Kindleberger traces patterns that repeat
Oh, what else?
over and over again, from the Tulip Mania back in the 1600s all the way to the dot-com bubble in the late 90s.
Yeah.
Human behavior, especially when there's a whiff of financial opportunity in the air,
Right.
tends to follow a predictable, if somewhat disastrous path.
Yeah, it's like we never learn.
It really is.
And what I found really intriguing
Yeah.
is how Kindleberger links these historical patterns to the idea of a lender of last resort.
Right.
It's a concept we hear about a lot. But today, we're going to really dig into its history, the pros and cons, both on a national and international level.
Absolutely.
Yeah.
The lender of last resort is a major player in how crises unfold
Right.
and how governments and institutions try to control the damage.
Right.
It can be a stabilizing force,
Yeah.
for sure, but it also raises some serious questions about whether bailouts actually encourage risk-taking in the first place.
Right.
That whole moral hazard dilemma.
Okay, so let's unpack this moral hazard thing a little further.
Sure.
Let's say a bank knows it's going to get bailed out by the government if things go south.
Right.
Doesn't that make them more likely to take bigger risks, knowing they won't face the full consequences? It's like giving a teenager a credit card with no limit.
That's the core of the debate. It's
Yeah.
a tough balancing act.
Right.
On one hand, you want to prevent a full-blown systemic meltdown.
Right.
But on the other hand,
Yeah.
you don't want to incentivize reckless behavior.
Right.
Think about it like this. If you know your car insurance will cover any accident,
Yeah.
no matter how reckless you are,
Mm.
wouldn't you be tempted to drive a little faster?
Right.
Maybe even run a red light or two?
Yeah, I see your point.
Right.
So it's not as simple as just stepping in and handing out money.
It's not.
So how do we even get to the point where a lender of last resort is needed?
Well, Kindleberger lays out this whole model for how financial crises unfold.
Okay.
He starts with something he calls a displacement.
Mm.
Basically, an external shock to the system.
Okay.
Something that comes out of left field,
Right.
shakes things up.
Mm.
Could be a technological breakthrough, a war, political upheaval,
Right.
even a sudden jump in the price of, say, oil.
Yeah.
The point is, it throws everyone off balance.
Right.
Often triggers a wave of optimism,
Mm.
a sense that fortunes are about to be made.
So something like the dot-com boom,
Yeah.
all that excitement about the internet and its potential.
Spot on.
Yeah.
The internet was a total game changer.
A technology that seemed to have limitless possibilities,
Right.
that sense of potential, ignited a frenzy of investment,
Yeah.
speculation,
Yeah.
in anything related to the internet.
Hmm.
It was the perfect example of a displacement setting the stage for a classic boom and bust cycle.
But the initial displacement is just the first domino, right?
It is.
Things really get out of control when easy credit enters the picture.
Oh, absolutely.
Like pouring gasoline on a fire.
Absolutely. And this is where Hyman Minsky's model comes in.
Hope.
Minsky argued that economic booms
Right.
often lead to looser lending standards.
Hmm.
Banks get caught up in the excitement,
Right.
start handing out loans like candy.
Yeah.
And you know what?
Right.
A lot of those loans end up going to pretty risky ventures.
Right.
Things that would never get funded in a more cautious environment.
So everyone is riding this wave of optimism,
Yes.
and nobody wants to be left behind.
Right.
But as like you said earlier,
Uh-huh.
not all of those ventures are seaworthy. Nope.
Some of them are just waiting to capsize.
Exactly. Minsky called this pro-cyclical lending. Basically, lending that fuels the boom
Right.
makes it even bigger.
Yeah.
As more money flows into the system,
Right.
it pushes asset prices higher and higher,
Yeah.
creating this self-reinforcing cycle.
Right.
Rising prices make investors feel invincible, so they borrow even more to chase those returns.
Hmm.
It's like a financial game of musical chairs.
Okay.
Everyone scrambles to get a seat while the music is playing.
Right.
But when it stops,
Yeah.
somebody's going to be left standing.
And that's when the bubble bursts.
It's
People realize they've been caught up in a frenzy,
Yeah,
and suddenly everyone wants to cash out.
exactly. The party can't last forever.
Right.
When asset prices finally start to drop,
Hmm.
the whole dynamic reverses.
Okay.
Investors panic,
Right.
rush to sell.
Yeah.
Lenders slam on the brakes. tighten credit. The whole thing goes into a downward spiral.
Right.
The very same forces that drove the boom up now work in reverse, pulling everything down with incredible force.
Okay, so we've got this initial shock, the displacement, then easy credit feeling, the frenzy.
Yep.
It's like a recipe for disaster.
It is.
But where does the psychology of the crowd come in?
Well,
how does all of this tie into those manias and bubbles Kindleberger talks about?
That's the heart of it. It's this herd mentality.
Yeah.
That fear of missing out that drives so much of the behavior we see during bubbles.
Right.
People see their neighbors, their colleagues, even complete strangers getting rich. And they don't want to be left behind.
Right.
Logic goes out the window.
Yeah.
Everyone piles into the latest hot investment, whether it's tulip bulbs, internet stocks, or whatever the flavor of the day is.
So it's like a social contagion. One person's excitement spreads to another. Yep. And before you know it, the whole market is caught up in a frenzy.
That's a great way to put it. And this is where Kindleberger's historical examples really come alive.
Okay.
He dives into some fascinating stories from the South Sea bubble and the Mississippi bubble in the 18th century to the Japanese real estate bubble of the 1980s.
Yeah.
Each one has its unique quirks, but they all share that common thread of irrational exuberance fueled by easy credit and the psychology of the crowd.
You know, I've heard of the South Sea bubble.
Sure.
But I have to admit, I'm a little fuzzy on the details.
Okay.
What made it so remarkable?
Well, picture this.
Okay.
It's the early 1700s. England is buzzing with excitement about the South Sea Company.
Yeah.
They've been granted a monopoly on trade with South America, a land of untold riches, or so everyone believes.
Okay.
People are practically tripping over themselves to buy shares, convinced they're about to strike it rich. Even the British ambassador in Paris, surrounded by the French frenzy over John Law's Mississippi Company, was begging for a way to get in on the action.
So it was all about the potential of this new trade route.
It was.
But I'm guessing things didn't quite pan out as everyone hoped.
You're catching on.
Yeah.
The reality was that the South Sea Company's prospects were wildly overblown. The actual trade was much less lucrative than investors imagined.
Okay.
But that didn't stop share prices from skyrocketing to absurd levels.
Yeah.
People were buying shares not because of the company's performance, which was pretty mediocre, but on the sheer belief that they could sell those shares to someone else for even more later on.
Right.
It's the classic greater fool theory at work.
So it was all built on hype and the hope that there would always be a bigger fool willing to pay more.
Yeah.
And of course, eventually the music stopped and there were no more fools left.
Precisely.
Yeah.
When reality finally set in, share prices crashed, triggered a wave of panic and financial chaos. Fortunes were wiped out, and the fallout had a ripple effect throughout the entire British economy. The South Sea bubble became a cautionary tale, a stark reminder of the dangers of unbridled speculation and the power of crowd psychology to drive markets to extremes.
It sounds like a wild ride.
Oh, it was.
But I can't help but wonder.
Yeah.
Didn't something similar happen in France around the same time?
You're right.
You mentioned John Law and the Mississippi Company.
The Mississippi bubble unfolded almost simultaneously with the South Sea bubble, and it was just as dramatic, if not more so.
Okay.
John Law,
yeah,
a Scottish economist, and gambler.
A gambler, okay.
Managed to convince the French regent, Philippe d'Orléans, that he could solve France's financial woes with a bold new scheme.
Okay, so this is getting interesting.
It is.
What was this grand plan?
Law. Paper money.
Okay.
Backed by the vast potential of the Mississippi Company.
Which had exclusive rights to trade with the French Louisiana territory in North America. He painted a picture of a land teeming with gold and silver, ripe for exploitation, immense profits. It was a vision that captured the French imagination, sent investors into a frenzy.
So, like the South Sea Company, it was all based on the promise of riches from a far-off land.
It was.
But I'm sensing a theme here.
You are.
It probably didn't quite live up to the hype.
You're catching on. The Mississippi Company's actual operations in Louisiana were far less impressive than Law had advertised. The reality was that the colony was sparsely populated, development was slow, and profits were meager. But that didn't stop the share price from exploding.
Yeah.
People were buying into the dream, fueled by Law's charisma and the general euphoria that gripped France at the time.
So it was another case of the greater fool theory.
People buying not based on fundamentals, but on the hope they could sell to someone else at an even higher price.
Yes.
And just like in England, the bubble eventually burst, leaving a trail of financial ruin.
It did.
Shattered dreams.
Yes.
The collapse of the Mississippi Company had a devastating impact on the French economy.
It did.
It took years for the country to recover.
It did.
It's fascinating how these bubbles, separated by geography, but occurring almost simultaneously, both highlight the same underlying dynamics.
They do.
It seems like human nature, when faced with the allure of quick riches, is prone to the same kind of irrational behavior, regardless of location or time period.
That's the key takeaway from these historical examples. They serve as a potent reminder that the basic human emotions of greed and fear are powerful drivers of market behavior. They can lead to excesses that ultimately prove unsustainable.
It makes you wonder, if it happened then, could it happen again?
It's a great question.
Are we really any smarter than those caught up in the South Sea and Mississippi bubbles centuries ago?
That's the million-dollar question.
Right.
And it's one we'll explore further as we delve into more recent examples like the Japanese real estate bubble and the dot-com bubble.
This is getting really interesting.
It is.
I'm ready to dive deeper into these more recent examples.
Well, sure.
But before we do, let's take a step back and talk a bit more about the role of credit and financial innovation in fueling these crises.
Absolutely.
Kindleberger argues that they often act as accelerants, right?
They do?
Like they pour fuel on the fire of speculation.
Absolutely.
Financial innovation in itself can be a force for good.
It can.
It can drive economic growth.
It can.
And create new opportunities.
Yes, but it also has a dark side. When combined with easy credit. It can create entirely new avenues for excessive risk-taking. It's like giving someone a shiny new sports car. But forgetting to mention the faulty brakes.
So it's not that innovation is inherently bad. But it can be dangerous when it outpaces our ability to manage the risks it creates. It's like we're constantly inventing new and exciting ways to get ourselves into trouble.
That's a great analogy. It's like we're always pushing the boundaries of what's possible in finance. But sometimes we forget that those boundaries exist for a reason. We get so caught up in the excitement of the new that we overlook the potential consequences.
Do you have any examples of how this innovation gone wrong has played out in history?
I do.
Specific cases where financial innovation coupled with easy credit led to a crisis?
Plenty. One example that Kindleberger highlights is the gold exchange standard that emerged in the early 20th century. It was a system designed to expand international trade and finance, but it also introduced a new layer of complexity and risk into the global financial system.
But how exactly did it work?
Imagine a house of cards. Each card represents a country's financial system. They're all precariously balanced on top of each other. The gold exchange standard was like adding a bunch of extra cards to this already shaky structure, making it even more vulnerable to collapse.
I'm intrigued, but I need a bit more explanation. How did adding these extra cards create instability?
Well, the gold exchange standard essentially allowed central banks to hold foreign currency reserves in addition to gold as backing for their own currencies. This, in theory, was supposed to increase liquidity and facilitate international trade. But it also created a complex web of interconnectedness between different countries' financial systems.
So if one country's financial system started to wobble, it could easily spread to others.
Exactly, like that house of cards. If one card starts to slip, the whole structure is at risk of collapsing. And that's precisely what happened during the Great Depression. The collapse of the Austrian Creditanstalt in 1931 triggered a chain reaction that spread throughout Europe and eventually the United States.
It's amazing how a seemingly technical change, like allowing central banks to hold foreign currency reserves, could have such far-reaching consequences. It really highlights how interconnected the global financial system is.
It does, and it underscores the importance of understanding the unintended consequences of financial innovation. Sometimes what seems like a clever solution can actually introduce new and unforeseen risks into the system.
So we've got the gold exchange standard as one example of innovation gone wrong.
Right.
Do you have any other examples, maybe something a little more recent?
Absolutely. Another example that Kindleberger discusses is the rise of junk bonds in the 1980s.
Junk bonds.
Fueled by the financial innovations of Michael Milken.
Those don't sound very safe.
They weren't.
Right.
Junk bonds are essentially high-yield, high-risk debt. Issued by companies with poor credit ratings.
Okay.
They're the financial equivalent of a subprime mortgage. Milken figured out a way to package and sell these bonds to investors.
Okay.
Creating a flood of capital for leveraged buyouts.
Right.
And other risky ventures.
So he found a way to make risky investments seem more appealing.
Exact.
Even though the underlying fundamentals were shaky.
Exactly. And for a while, it seemed like a brilliant strategy. The junk bond market exploded, fueling a wave of corporate takeovers and restructurings. But just like with the gold exchange standard, there were unintended consequences.
I'm guessing those consequences weren't pretty.
You guessed it. The junk bond boom eventually contributed to a wave of corporate collapses and financial scandals in the late 1980s and early 1990s. It was a classic case of excessive risk-taking, fueled by easy credit and financial innovation.
So we've got these historical examples.
Yeah.
And they're all fascinating.
They are.
But I'm starting to feel a little overwhelmed.
Okay.
Is there a common thread that runs through all of these crises?
That's a great question.
Some underlying principle.
And yes, there is.
That connects them all.
Kindleberger argues that at the heart of most financial crises lies a fundamental disconnect between expectations and reality. People get caught up in the euphoria of the moment, believing that asset prices will continue to rise indefinitely.
Right.
They ignore the underlying risks fueled by easy credit and the intoxicating allure of quick riches.
It's like that old saying, if it sounds too good to be true, it probably is.
It probably is.
But how do we guard against this?
Wow.
How do we avoid falling into the same traps that ensnared investors for centuries?
That's the challenge, isn't it?
It is.
And it's one we'll explore further as we delve into the role of the lender of last resort, psychology of bubbles, and the ever-present threat of swindles and fraud.
Okay, I can't wait to hear more.
Sure.
But I think we need to take a quick break to let all this information sink in.
Okay.
We've covered a lot of ground already.
We have.
And I know I need a few minutes to process it all.
A good idea.
Yeah. All right, so we've laid the groundwork. We know how crises tend to brew.
Yeah.
We've glimpsed the danger of those displacements Kindleberger talks about.
Right.
But let's fast forward a bit in history.
Sure.
You mentioned the Japanese real estate bubble.
Yeah.
Now that one really captures the imagination.
It does.
I mean, at one point, the Imperial Palace in Tokyo was supposedly worth more than all the real estate in California.
It's unbelievable.
That's just mind-boggling.
It really is. The Japanese real estate bubble of the 1980s is a textbook example of how things can spiral out of control.
Yeah.
It's almost hard to believe how high prices soared. Imagine a single square foot of prime real estate in Tokyo costing more than an entire apartment in some parts of the U.S.
Wow.
It was pure speculative frenzy.
It's crazy to think about.
It is.
But what drove such a massive bubble?
Bo?
Was it just a case of easy credit and herd mentality?
Well...
Or were there other forces at play?
It was a perfect storm of factors, really. You had easy credit, of course, with banks practically begging people and businesses to borrow money. Then you had the deregulation of the financial system, which made it even easier for money to flow into real estate.
Yeah.
But there was also this cultural belief in Japan that real estate values would simply never go down.
Okay.
It was considered a surefire investment.
So it was a combination of economic factors and cultural beliefs that created this sense of invincibility.
Precisely.
Like everyone believed they were playing a game they couldn't lose.
Exactly. And it wasn't just individual investors who were caught up in the frenzy of Japanese corporations. Flush with cash from the country's booming export economy, started pouring money into real estate.
Yeah.
They even began using real estate as collateral for more loans, further inflating the bubble.
So at some point, companies realized that investing in buildings was actually more profitable than making things.
Right.
It's almost comical.
It is.
Companies forgetting their core businesses.
Yeah.
Because real estate was the hot investment.
It was the place to be.
But as we know, all bubbles eventually burst.
They do.
What was the trigger for the Japanese bubble?
Yeah.
And what were the consequences?
Well, like most bubbles,
Yeah.
it was a combination of factors that led to the crash.
Okay.
The Bank of Japan started raising interest rates to cool down the overheated economy, which put a damper on borrowing.
Right.
At the same time,
Right.
the government introduced new regulations aimed at curbing real estate speculation.
So it was a deliberate attempt to deflate the bubble.
You could say that.
A controlled demolition, so to speak.
But even controlled demolitions can have messy consequences.
Oh, yeah.
The Japanese real estate bubble burst with a resounding thud in the early 1990s. And the country entered a period of economic stagnation that became known as the Lost Decade.
The Lost Decade. That sounds ominous.
Was.
What were the lasting effects of this crash? Did Japan ever fully recover?
It was a brutal period for the Japanese economy.
Yeah.
Stock prices plummeted. Real estate values cratered.
Right.
Banks were saddled with bad loans. The country struggled with deflation, low growth, high unemployment for years.
Wow.
It's a testament to how damaging these bubbles can be.
Right.
The hangover can last for decades.
It's a cautionary tale for sure.
It is.
It makes you wonder, are we any better at recognizing and avoiding these bubbles today?
Wow.
I mean, it's been a while since the Japanese real estate bubble.
Right.
But haven't we seen similar patterns play out in more recent times?
We certainly have. The dot-com bubble of the late 1990s and early 2000s is a perfect example.
Ah, the dot-com bubble. That was a wild time.
It was.
I remember all the talk about a new economy, how the internet was going to change everything.
Right.
It felt like everyone was trying to get in on the action.
Yeah.
Even if they didn't really understand what they were investing in.
That's a perfect description of the dot-com mania.
Yeah.
Valuations for internet companies soared to astronomical levels, even for companies with no profits, no revenue, and sometimes no real business plan.
Yeah.
It was all about the promise of future growth.
Right.
The potential of this new technology to disrupt entire industries.
And of course, that potential was real.
Oh, it was.
The internet did transform the world.
It did.
But in the late 90s, it felt like the market was valuing that potential based on pure speculation.
Right.
Not on any kind of rational analysis.
Exactly. It was as if investors had completely suspended disbelief, caught up in a collective fantasy of instant riches.
Yeah.
Remember Pets.com?
Yeah.
They sold pet supplies online.
Right.
Perfectly fine business idea. But at its peak, the company was valued at over $8 billion.
Wow.
Despite losing money on every sale.
Pets.com. I remember their sock puppet mascot.
I know, right?
It's hard to believe that company was worth billions.
It is.
It's a perfect example of how irrational things can get during a bubble.
It is.
But what about other companies? Were there any red flags that investors were overlooking?
Oh, there were plenty of red flags. Companies with no clear path to profitability were going public, raising millions, even billions of dollars.
Wow.
Investors were piling into initial public offerings, IPOs, with little regard for the fundamentals. It was pure speculation, driven by the fear of missing out on the next big thing.
Right.
Remember, in the dot-com era, IPOs weren't just investments, they were events, social occasions.
It's amazing how social dynamics can influence financial decisions.
They can?
But even in a bubble, there must have been some people who saw the warning signs, right?
Of course.
People who knew it couldn't last forever.
There were always skeptics,
Yeah.
people who cautioned against the irrational exuberance,
Right.
but their voices were often drowned out by the chorus of optimists.
Yeah.
It's like that old saying, when the music is playing, you've got to get up and dance. And during the dot-com boom, the music was deafening.
So when did the music finally stop?
Well,
What popped the dot-com bubble?
like most bubbles,
Right.
it was a combination of factors.
Whoa.
Interest rates started rising, making it more expensive to borrow money.
Right.
And then the tech-heavy NASDAQ stock market began to falter as prices started to fall.
Right.
Investors' confidence wavered, and the rush to the exits began.
Yeah.
The bubble burst in spectacular fashion in early 2000, sending shockwaves through the global economy.
And just like the Japanese real estate bubble, the dot-com crash had long-lasting consequences, right?
Absolutely.
Weren't there a lot of job losses and economic fallout?
Absolutely. Thousands of dot-com companies went bankrupt. Millions of investors lost their savings.
Yeah.
The tech sector, which had been the engine of economic growth for years, went into a slump.
Right.
It took years for the economy to fully recover.
These bubbles are fascinating.
They are?
But also a little terrifying.
They are a little bit scary.
It's like watching a train wreck in slow motion.
Yeah.
You know it's going to happen, but you can't look away.
I know.
But beyond the drama and the financial devastation, what's the real lesson here?
Yeah.
What can we learn from these historical examples?
That's the key question.
Yeah.
I think Kindleberger provides some valuable insights.
Okay.
One of the key takeaways is the importance of understanding the role of credit and financial innovation in fueling these crises, these factors, while potentially beneficial for economic growth, can also create opportunities for excessive risk-taking and speculation. It's a double-edged sword.
So it's not about demonizing credit or innovation.
It's not.
But about being aware of the potential downsides. About striking a balance between encouraging economic growth and managing the risks.
Exactly. It's about having a healthy dose of skepticism, about questioning assumptions, and about being wary of those who promise easy riches. It's about recognizing the signs of a bubble and understanding the psychology that drives them.
So we need to be savvy investors.
We do.
Not just blindly following the herd. But what about the role of government? Isn't there a role for regulation and oversight to prevent these bubbles from getting out of control?
Absolutely. That's a crucial part of the equation.
Okay.
But it's a delicate balancing act.
Too much regulation can stifle innovation and economic growth. Too little regulation can create an environment where excessive risk-taking and fraud flourish.
So it's about finding that sweet spot.
It is.
The right level of regulation. To protect the system without stifling innovation.
Exactly.
But even with the best regulations, can we really prevent these bubbles from happening?
Well,
aren't they just part of human nature?
That's a great question.
Yeah.
And it's one that leads us back to Kindleberger's central thesis.
Okay.
He argues that financial crises are in many ways a recurring feature of market economies. They're driven by human nature, by our inherent biases, our tendency toward irrationality.
So are we doomed to repeat these mistakes? Is there no hope? Or are there steps we can take, both as individuals and as a society, to mitigate the damage? Maybe even prevent the next big bubble?
That's a question we'll explore further as we delve into the role of the lender of last resort.
Okay. And the fascinating but often unsettling world of swindles and fraud. Because as we've seen throughout history, where there's money to be made, there will always be those who are willing to bend the rules or even break them to get their share.
I'm ready to dive into that.
Let's do it.
Okay, I think we're ready to tackle the final stretch of this financial roller coaster. We've talked about the anatomy of crises, the heady rush of bubbles, even how seemingly good ideas like financial innovation can lead to unexpected consequences.
Absolutely.
But let's face it.
Sure.
No deep dive into financial history would be complete without talking about the bad guys. The fraudsters, the swindlers, the folks who take advantage of the chaos to line their own pockets.
It's an essential part of the story, and it's fascinating in a slightly disturbing way. How economic brooms seem to attract a certain breed of opportunists. They're like moths drawn to a flame.
Always looking to exploit the climate of euphoria and greed that takes hold during those heady times.
So who are some of these infamous characters? Well, I'm imagining those old-timey newspaper cartoons with guys in pinstripe suits, slicked back hair, disappearing with bags of money.
Well, you're not far off.
Okay.
One of the most notorious figures in financial history is Charles Ponzi.
Okay.
His name has practically become synonymous with shady schemes back in the 1920s. He managed to convince thousands of people to invest in his postal reply coupon scheme.
Wait, postal reply coupons? That sounds incredibly boring.
It does.
How did he manage to pull that off?
It was all smoke and mirrors, really.
Oh, okay.
Ponzi claimed he could arbitrage postal reply coupons, buying them cheaply in one country, selling them for a profit in another.
Okay.
He guaranteed investors a 50% return in just 45 days.
50% return in 45 days?
Yeah.
That should have set off alarm bells.
It sounds too good to be true.
Right.
Which, as we know, is usually a major red flag.
Exactly. But Ponzi was a master manipulator.
Right.
He used the early investors' money to pay off later investors, creating the illusion of a successful venture.
Yeah.
It's the classic pyramid scheme,
right,
where the early birds get paid with the money from the later arrivals.
Right.
It works until it doesn't. Then the whole thing collapses like a house of cards.
You know, it's amazing how some scams never go out of style.
It is.
Pyramid schemes are still around today.
They are.
Even with all the warnings and awareness campaigns.
Right.
Makes you wonder,
yeah,
why do people keep falling for them?
It's a combination of factors, really. Greed plays a big role.
Of course.
People want to believe they can get rich quick.
Right.
They're willing to overlook obvious red flags when the promise of easy money is dangled in front of them.
Yeah.
But there's also an element of trust involved.
Okay.
Ponzi, like many con artists,
Right.
was charismatic, persuasive.
Right.
He knew how to gain people's confidence and exploit their vulnerabilities.
So it's not just about the money,
It's not.
but about the psychology of persuasion.
That's a big part of it.
Makes you wonder, if someone like Ponzi were around today,
Right.
would they be able to pull off the same kind of scheme?
It's hard to say for sure,
Yeah.
but I wouldn't underestimate human nature.
Right.
The tools might change. Maybe instead of postal reply coupons, maybe some obscure cryptocurrency or a complex financial derivative. But the underlying principles of greed, deception, and trust remain the same.
Okay, so we've got Charles Ponzi,
Right.
his postal coupon scheme.
Right.
Who else is on the roster of financial infamy?
Well, another fascinating case is Nick Leeson,
Okay.
the rogue trader who single-handedly brought down Barings Bank.
Wait, one guy
One guy.
brought down an entire bank.
Yep.
That's incredible.
It is a crazy story.
What did he do?
Leeson was a trader in Barings' Singapore office.
Okay.
He was basically gambling with the bank's money,
Right.
making risky bets on the Japanese stock market.
Mm.
He hid his losses in a secret account,
Right.
hoping to make them back before anyone noticed.
It sounds like something out of a movie.
It does.
A high-stakes gamble with someone else's money.
Right.
But how did he manage to keep it secret for so long?
Well,
Didn't anyone notice what he was doing?
that's the surprising part.
Yeah.
He managed to exploit weaknesses in the bank's internal controls and oversight. He was a master of deception,
Right.
creating false records and forging documents to cover his tracks. And for a while, he was incredibly lucky.
Right.
His bets actually paid off.
Wow.
Earned huge profits for the bank.
So he was like a gambler on a hot streak.
Yeah, for a while.
But eventually his luck ran out, right?
It always does.
Yeah.
When the Japanese stock market crashed in 1995, Leeson's losses spiraled out of control. He kept doubling down on his bets, hoping to recover,
Right.
but it only made things worse.
Yeah.
By the time his deception was uncovered,
Right.
Barings Bank had lost over $1 billion,
Wow.
forced into bankruptcy.
Wow, what a story.
It is.
It's a reminder that even with sophisticated risk management systems,
Right.
human error,
Uh-huh.
greed,
Right.
deception
Yeah.
can still wreak havoc.
For sure.
But these examples, Ponzi, Leeson,
Right.
they're all about individuals.
Okay.
What about corporate fraud?
Oh, yeah.
Didn't we see some major examples of that in the early 2000s?
Absolutely. The collapses of Enron and WorldCom in the early 2000s were major wake-up calls about the dangers of corporate fraud.
Right.
These were massive companies, considered pillars of the American economy,
Right.
but they were built on a foundation of lies.
Okay, remind me about Enron.
Sure.
That was the energy trading company, right? What did they do?
Enron engaged in a complex web of accounting fraud, using off-balance sheet entities, other dubious practices to hide billions of dollars in debt and inflate their earnings. They basically created a fantasy world where profits were soaring, even as the company was bleeding money.
So it was all about creating an illusion of success to fool investors.
Exactly.
But what about the auditors? Weren't they supposed to catch this kind of thing?
That's the disturbing part.
Yeah.
Enron's auditor, Arthur Andersen,
Right.
one of the big 5 accounting firms at the time, was complicit in the fraud.
Wow.
They turned a blind eye to the company's questionable practices. More concerned with protecting their lucrative consulting fees than with upholding their ethical obligations.
It's shocking how greed can corrupt even institutions.
It is.
That are supposed to be guardians of financial integrity.
Absolutely.
And what about WorldCom?
Well, WorldCom,
yeah.
a telecommunications giant, engaged in a different type of accounting fraud. They simply capitalized expenses that should have been recorded as costs,
right,
making their profits appear much larger than they actually were.
Right.
It was a blatant attempt to deceive investors and inflate the company's stock price.
So 2 different companies,
Yeah.
2 different methods, but the same underlying goal.
Right.
To mislead investors,
yeah,
enrich themselves at the expense of others.
Right.
It's a reminder that fraud can take many forms.
Yeah, it can.
And it's often difficult to detect until it's too late.
It is, for sure.
And the fallout from these scandals was immense.
It was.
Thousands of employees lost their jobs.
Right.
Investors lost billions of dollars.
Yep.
Public trust in corporate America was severely shaken.
Yeah.
It led to major reforms like the Sarbanes-Oxley Act of 2002, aimed at strengthening corporate governance and accounting standards.
Right.
So some good did come out of it,
Yeah.
at least in terms of tighter regulations, increased awareness of corporate fraud.
Right.
But these stories are pretty disheartening.
They are.
Makes you wonder, can we ever really trust the financial system?
Yeah.
Are we always going to be at the mercy of these bad actors?
That's a valid concern.
Yeah.
There's no easy answer.
Right.
I think one of the key takeaways from Kindleberger's work, from all these historical examples, is the importance of vigilance. We need to be aware of the risks, both at the individual and systemic level.
Right.
We need to ask tough questions. Demand transparency. Hold those in power accountable.
So it's about being informed,
and
engaged, skeptical,
right,
not blindly trusting the system or those who claim to have all the answers.
Exactly. It's about understanding that financial history is full of cycles, booms and busts, innovation and fraud.
Right.
And by recognizing these patterns, learning from the mistakes of the past, we can hopefully make better decisions in the future, create a more resilient and ethical financial system.
Well, that's a thought-provoking note to end on.
It is.
This deep dive into the world of financial crises has been quite a journey.
It has.
We covered everything from the psychology of bubbles
to
the intricate workings of the lender of last resort. And we've even encountered some of history's most notorious financial scoundrels.
We have.
I feel like I've learned a lot.
Good.
But I also have a renewed sense of caution about the financial world.
That's a healthy response.
Yeah.
Remember, knowledge is power.
Right.
By understanding the forces that drive financial crises, the allure of speculation, the dangers of fraud, you're better equipped to navigate the complexities of the financial world. Make informed decisions.
Absolutely. And to our listener, thank you for joining us on this deep dive.
Yes, thank you.
We hope you found it as fascinating and enlightening as we did.
We did.
Remember, the more you know about financial history,
yes,
the better prepared you'll be for the future.
Absolutely.
And, as always, if something sounds too good to be true, it probably is.
It probably is.